Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding Futures Contracts, a comprehensive guide. Ever wondered how investors can purchase something without actually owning it? Futures contracts allow investors to do just that. These financial tools are agreements to buy or sell a particular asset at a predetermined price at a specific time in the future. Whether you're looking to hedge against market volatility or speculate for potential profits, futures contracts offer a way to manage financial exposure. Futures contracts are pivotal in global markets, impacting everything from commodities like oil and wheat to financial instruments like indices and currencies. By locking in prices, these contracts help businesses and investors navigate uncertain market conditions with more confidence. Ready to uncover the details? You'll soon grasp how futures contracts can play a significant role in your investment strategy. What are futures contracts? Futures contracts are an essential part of the financial markets. They allow investors to plan for the future and manage risks. Let's dive into what futures contracts are and how they work. Definition and key components. A futures contract is an agreement between two parties to buy or sell an asset at a future date and at a pre-agreed price. This sounds straightforward, but let's break down the key components. Underlying asset. This is what the contract is for. It could be anything from commodities like oil and gold to financial assets like stocks or indices. Contract size. This specifies the amount of the asset to be traded. For example, a contract might represent 1,000 barrels of oil. Expiration date. This is the date when the contract must be settled. On this date, the buyer and seller complete the transaction at the agreed-upon price. In simpler terms, think of it like a promise to buy or sell something in the future, but at a price you decide today. Here's a quick list to sum it up. Underlying asset, the item being traded. Contract size, the amount of the item. Expiration date, when the trade must happen. Historical background. The concept of futures contracts has a rich history dating back centuries. It all started in ancient markets where farmers and merchants needed ways to secure prices for their goods ahead of time. Early beginnings. The origins trace back to ancient Mesopotamia, around 1750 BC. Here, clay tablets recorded agreements for future delivery of goods. Modern development. The 19th century saw the formalization of futures trading. The Chicago Board of Trade, CBOT, was established in 1848, creating standardized contracts that made trading more efficient. Global expansion. Over time, the appeal of futures contracts spread globally, with major exchanges forming in Europe and Asia. The financial markets of today owe much to these early developments. From ancient clay tablets to modern digital trading platforms, futures contracts have evolved to become a cornerstone of global finance. They provide a way to manage risks and speculate on price movements, which is crucial for both companies and individual investors. Understanding these basics can help you see why futures contracts are so important in today's financial world. How futures contracts work. Understanding how futures contracts work is vital if you're looking to get into futures trading. These contracts are more than just agreements. They represent a dynamic aspect of today's financial markets. Here's a look at their mechanics. Trading and settlement. Trading futures contracts involves several steps, making the process both strategic and intricate. Trading process. Opening an account. To trade futures, you need to open an account with a brokerage firm that offers futures trading. Make sure to choose a broker carefully, as fees and support can vary. Placing orders. Once your account is set up, you can place orders. These orders can be market orders, buy, sell immediately at the current price, or limit orders, buy, sell only at a specific price. Contract specifications. Every futures contract has specific details like the underlying asset, contract size, and expiration date. Knowing these is crucial for making informed decisions. Trading platforms. Trading is done on exchanges like the Chicago Board of Trade, CBOT, or electronically via trading platforms, which provide real-time data and tools for analysis. Settlement procedures. Delivery settlement. Some contracts require the physical delivery of the underlying asset. This means if you bought a contract for 1,000 barrels of oil, you'd receive the oil upon settlement. Cash settlement. More common than physical delivery, cash settlement involves paying the difference between the contract price and the market price at expiration. Trading and settlement are the heartbeat of futures markets. Think of trading as the setup and settlement as the conclusion of a play. Each part is necessary to make the entire system work seamlessly. Leverage and margin requirements. Leverage and margin are key concepts in futures trading. They can amplify your gains but also increase your risks. Leverage. Leverage allows you to control a large contract value with a relatively small amount of money. If you've ever wondered how traders manage to trade huge amounts of assets without needing the equivalent cash, leverage is the answer. For example, if a futures contract is worth $100,000, you might only need to put up $10,000 to control it. This means you're using 10x leverage. While this can magnify profits if the market moves in your favor, it can also magnify losses if it doesn't. Margin requirements. Margin is the collateral you need to deposit to open and maintain a futures position. There are two main types of margin in futures trading. Initial margin. This is the amount needed to open a position. Think of it as a good faith deposit. If you're trading a $100,000 contract with 10% margin requirement, you need to put up $10,000 initially. Maintenance margin. Once you have a position, you need to maintain a certain amount in your account to keep the position open. If your account balance falls below this level due to market movements, you'll face a margin call, requiring you to deposit more funds immediately. Using leverage and managing margin requirements can be a double-edged sword. On one hand, they provide opportunities to achieve higher returns with less capital. On the other hand, they can also lead to significant losses if not managed properly. The aspects of trading, settlement, leverage, and margin are fundamental to grasping how futures contracts work. Whether you're a novice trader or looking to expand your financial knowledge, these concepts are essential. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.